Welcome to Retirementals, a podcast that dives headfirst into the issues facing the financial sector at the intersection of investment, technology, and financial advice. Hosted by Abraham Okusanya, you can expect raw honesty, critical analysis, and energetic interviews. Here is your host, Abraham Okusanya.
Hi folks, welcome to Retirementals. I am really excited about my guest today and the conversation that we are about to have. Catherine Williams is Vice President and Head of Advisor Practice Management at Dimensional and the host of Managing Your Practice podcast. Catherine, welcome to Retirementals.
Hi, Abraham. It's great to be here. Thanks for having me.
So as I was saying to you before the call or before we went live, I am a big fan of your podcast. I have binged, all the episodes this year, and I'm looking forward to, what you've got in store. I really want to have a conversation with you today about some of the great work that you've been doing with financial advisors in the US and the latest studies, the dimensional benchmarking studies that you've recently published. But before we dive into all of that, do you want to give us a little bit of a background, about yourself, how you got into the industry, and the work that you do today with Dimensional?
I'd be happy to, and by the time I'm done, you'll get a sense of how old I am. I've been doing this for a while, but I sort of stumbled into the industry, which I think a lot of people maybe say here and there. I was a broadcast journalism major and I know the irony, right? I needed to pay some bills. And so I took a job at a small cap value stock picking shop, which, if you know anything about Dimensional's investment discipline, the irony is there for sure. But it was a great place, really interesting place to sort of cut my teeth on the industry here in the U.S. Living and dying by your performance really it reveals, I think, a lot about your own internal character and fortitude, if you will. But pretty quickly after that, moved to an investment advisory firm in the Seattle area. I was there nearly 15 years, and that firm during my time there grew from about 300 million to over $1 billion. And we did that both organically as well as through acquisition. So again, rapid learning, a huge learning curve there. And I was COO there for a handful of years. So just, I always have such an appreciation for how advisors are navigating their businesses today and what that takes. So that was certainly an incredibly informative experience. The last several years, I have been primarily focused on coaching and consulting with advisors really around the world, and certainly here predominantly in the U.S. And that ultimately led me here to Dimensional. As a consultant to advisors, when you can lean into the conversation from a place of data, from a place of understanding, from a metric standpoint, not only what's going on in the advisor's business, but how they look against their peers and against that larger industry, that really can help, that informs the conversation. And certainly here at Dimensional, data is in our DNA. We have a very academic approach to investing, and we take a similar methodology here in the practice management team when it comes to running two large global studies. That is really the primary conduit for some of the data we're going to talk about today, and how we spend our time with advisors.
Brilliant stuff. Thank you for that introduction. So that's a great segue into the global advisor and global investor studies. So give us a little bit of a background to these benchmarking studies you've been doing.
So the Global Advisor Study is all about the advisor's business. And it started first here in the United States. This is our 11th year here in the United States. We began it a few years after that in the broader international community. So we now run this study in the US, EMEA, Canada, and Australia. And it's all about helping advisors understand what's going on across their business. So certainly we're heavily invested relative to the investment platform that an advisor has, but we recognize and we believe wholeheartedly that to have a long-term, healthy, viable business, you really do need to look at all areas of the business. And we wanted to think about how could we be a resource. So that study was created. We gather all kinds of business metrics. We ask questions around how you're growing, how you're hiring and developing people. Your technology is a big one. That's been a big one for quite some time. And then we play those results, if you will, back to the participants in the study. And for the 2021 study, which actually just officially wrapped with Australia, we had nearly 1,000 advisors in this study this year. So really nice sampling, if you will, a great cut of advisors. It is only available to advisors that currently work with Dimensional, but some great insights are gained from that. I know we're going to talk a little bit about that today. The Global Investor Study is not quite as old. It's about five years old, I would say, and it's all about the end client. So it's a fully sort of white labeled vehicle, if you will, for advisors to gain understanding, get feedback, client satisfaction, what is top of mind for them. And we love nothing more than when an advisor participates in both those studies. I was actually meeting with a group of COOs yesterday, and I said to them, this might come as a surprise to you, but you don't always know exactly what your clients are thinking. We think we do, right? We think we know, but asking clients, gathering their insights, gathering their feedback. We have an NPS, a Net Promoter Score functionality in that study. And last year we had nearly 17,000 end clients participate in that study. So you can definitely get a little bit of insight as to what your clients value, what's top of mind for them, how do they really want to engage with you long term in that advisor-client relationship.
That's brilliant. The Global Advisor Studies will be very relevant to a lot of advisors listening to this podcast, right? And many of whom use our TAM service, Betfolio, which is very heavily dimensional. So give us a picture in terms of what you're seeing in the studies in terms of the revenue, AUM and the key metrics, for advisors.
So a couple of things there, and I think I'll answer the question in terms of how we analyze the data in a lot of different ways. But one of the ways that we look at the data each year is this idea of, if you think about just based on a percentage of revenue growth. So take AUM out for a moment and think about revenue growth. What are top quartile or faster growing firms doing versus slower growing firms? I always want to qualify this and say that growth does not have to mean you want to be 10 times where you are today.
Right.
A highly valued advisory business, one that is just growing at a nice steady pace, that's fantastic. And quite honestly, as we look at the M&A, mergers and acquisition environment, those are well sought after. Those are highly valuable businesses.
Yes.
So I always want to give advisors, anyone who's listening, anyone that joins any of our presentations, I want to give them permission, so to speak, to not think about this as, wow, I must be growing lights out in order to be successful long term. So with that said, our top quartile firms on average had an average revenue growth rate of around 26% last year. So incredibly healthy. About 10% of that was merger and acquisition activity. So certainly here in the US, that is really top of mind. The bigger firms are looking at that as a true channel of growth. So I always want to make sure we put that in there. The slower growing firms were in the just positive a couple of percent. So you can see quite a difference, quite a delta, if you will, between that. So from there, what do we see? What are these firms doing that are creating healthy, vibrant, growing businesses? And we continue to see some strong characteristics around the growth channels. Client referrals is the number one growth around the world for advisors. But we see with top quartile firms that they're doing a couple of things. One, they don't just rely on client referrals. They're thinking about COIs. They're deploying digital marketing. They're, of course, as I mentioned, pursuing M&A. But even with the client referral piece, we find that they tend to have a way to sort of lean into that conversation with clients about especially with the clients they would like to replicate, right? We probably
Right.
raise your hand if you have clients you do not want to replicate. So you're not necessarily asking for referrals. In fact, you don't ask for referrals. That's a poor way to phrase that. But they're leaning into that conversation and they're getting purposeful about creating a referral experience. Clients want to refer, and then helping them know how to do that. So we continue to see those characteristics really come forth with those with clients. From a business development standpoint, top quartile firms have taken the time to develop their value prop, and it's not just something that a few people in the organization can speak to. Everyone in the organization understands the value proposition, they can articulate it, and it informs the decisions they make in their business each day. They've taken the time to identify their ideal target client profile, who they most want to work with. So these firms have gotten really systematic about that. And as we're going to talk about today, when you start then adding in people and technology and setting goals, right? Like you have to have a plan, and not just a plan that's running around in one person's head. It's pen to paper. You've really mapped this out. We continue to see that. Operating profits do tend to be the profit margin actually tends to be a little bit lower for faster growing firms. They're reinvesting in the business. Slower growing firms tend to, kind of be in that 26 to 27% operating margin, profit margin, whereas the faster growing might be 22, 23. So it's not a huge difference, but they do continue to have a lower operating profit. And so we've seen that sort of inverse relationship between revenue growth and operating profit margin for a number of years. That when you're really in that fast growth mode, when you're really dialing up that growth mechanism, that muscle, if you will, in the business, your operating margin might be a little bit lower than you might see in a slower growing firm. So those are some of the things that we definitely see from the study.
Fascinating stuff. There are lots of questions in my mind around this, and I'm trying to sort of decide where I focus on. So I'm just going to say, so let's go. So give us a flavor of what those faster growing firms look like in terms of, I don't know, AUM, size of the firm. Is there any correlation there that you can draw in terms of between amongst those firms, those faster growing firms?
So from an AUM standpoint, it actually runs the gamut. And we have firms that are, small, what we call sole proprietor firms. And then we work with, billions and firms that are in the billions and billions of dollars. And that's one reason why we pick the revenue swim lane, so to speak, versus the AUM. So obviously headcount, things like that. So what does that mean then? We have to, as you're, I think, as you're asking, like, what do we ultimately get to create, what are some of the metrics we look at to really help firms understand? And certainly one of them that we, a long time area of focus, this helps firms think about capacity, certainly their productivity, their revenue, and that is what we call that revenue per full-time employee metric. And again, this, because we're not, and we slice the data a lot. We geek out on it all year long. And so with that said, when we look at that revenue per full-time employee number, on average across our study, that number has sat right around, let's say, 315,000, and I'm just using American dollars here, pretty consistently, and that shows up, as well for the unique EMEA and UK advisor audience. The faster growing firms, they tend to run, a little bit leaner. Their teams are a little bit leaner. Part of that is they have dialed in around the technology piece. I don't know any of them that would say they've perfected it. And we see a lot of focus in the study this year around profitability. So even these faster growing firms who have great pipeline, great people, great technology, they're still wrestling with, are we really getting everything out of the business that we possibly could? So that revenue per full-time employee, revenue per senior advisor, which is, in our study, a senior advisor versus a service advisor is someone who has that rainmaking responsibility, right? They're bringing revenue into the organization. And that, again, those numbers have been, fairly consistent year over year, but those are some of the areas that we look at to help sort of level out, if you will, some of the metrics in the study. Does that answer your question?
Yeah, absolutely. Thank you. And is there a difference between the UK advisors and, say, the US advisors?
I do in some cases, but to sort of make a little bit of a joke about it. At the end of the day, we all put our pants on the same way.
Right.
like at the end of the day, I say that, because, and absolutely when I meet with US advisors, they're like, surely we're different than everyone else in the world. And, UK, Australia, all that. And there can be some nuances. I mean, I would say for the EMEA and UK firms from, we talked about those top quartile, bottom quartile from a growth metrics, that number is a little narrower, if you will. Within the UK, the number's
Right.
not quite as high for top quartile, not quite as low. It's a little more focused. I would say certainly from a what are some of the challenges in the business, if you will? Everyone talks about we want to improve workflow processes. We're thinking about developing our people. I see a little bit more with the UK EMEA around hiring and developing. That definitely really kicks up just a little bit. It's on the radar for everyone, particularly even after the last 18 months we've all been living in. But we do see some differences in our study each year. We do ask, what are top initiatives that you're focused on, and that's one that might tick up a little bit higher, if you will, in the UK. So how you're going about solving that can be a little bit differently, but it's one that's definitely top of mind.
So you talked about these fast growing firms investing more, spending more in technology, and clearly you can attribute a degree of their success to that. Talk a little bit about that point.
So actually, it's interesting. It's maybe even a little bit of Groundhog Day, where I think each year we're going to go into the study and the number will be dramatically different. But the
Right.
reality is, when it comes to the percentage of revenue that firms spend on technology. And I'm not talking about human capital, right? We're going to take that out of the equation. We gather income statement information, and comp is a separate section. But when you're talking about the hardware, the software, the sort of the deployment, the training of technology, we actually don't see a ton of movement from one year to the next. And more importantly, as a percentage of revenue, we don't see top quartile firms necessarily spending more on technology than we do slower growing. Now, how they spend those dollars, we do start seeing some differences for sure. But here in the US, it's been about 4% annually is the spend on technology. Again, you might have a firm here or there, maybe they're deploying a brand new piece of technology, things like that. Might be a little bit of an uptick. But for the most part, it's sat in that 3.5% to 4% range here in the US. And in the UK, that number has been right around 3.5%. So just a little bit lower, and it's hung out there for a few years now. So why is that important? I think, first of all, the idea that you must be spending a ton of dollars on technology to be a top quartile firm is a misnomer. That's obviously not the case. Now, with that said, as firms get bigger, we do see an uptick in the human capital side of that. So they may go from having a complete outsourced situation with regard to technology and support to maybe hiring an IT administrator. And then, of course, you get bigger and more robust, and we'll see a full, chief technology officer, that sort of thing. So that certainly, when you lump that in, can raise that number over time. But when you think about actual spend of dollars on technology, it's actually been very consistent across the board.
And in terms of human capital, I assume that then dovetails into this conversation about compensation. Again, anything we can learn from, some of that the faster growing firms do differently than the slower growing firms?
In terms of technology?
In terms of people, the team, and compensation.
So, yes. Top quartile firms consistently spend more on compensation for their people overall than slower growing firms. This is not to say, anyone listening, that they must immediately go back and raises. Maybe they need to. That's not for me to say. But we do see that. And so instead of it being 46, 47% of that as a percentage, it's more like 50, 51%. Like it's a pretty healthy number. Absolutely. There's what you pay and there's how you pay it. And that is another difference with top quartile firms. They
Huh.
not only have taken the time to develop and by comprehensive, I don't mean complex, but they've built out a compensation plan. They have a compensation philosophy statement, right? They're really dialed in about
Wow.
what they want their comp to say, the behaviors that they're trying to drive, the behaviors they want to reward. And so if they're in growth mode, we often see, business development incentives. If you're on sort of we'll call it the house side of the business, maybe more behind the scenes, operations, technology, all of those team members have some sort of variable comp. I mean, it's not going to be as much as you would see perhaps in a senior advisor role, but everyone has an opportunity to move forward from and capture compensation that is variable. Maybe it's tied to the firm hitting a certain profit level or individual performance. So we see that year after year with the top quartile firms, very consistent. From a structural standpoint, we also see with top quartile firms when it comes to their people, and I always say this because compensation, you can have the best compensation plan in the world, but if you don't have an organizational structure, if you don't have role clarity, which can be hard to do when you're, just growing rapidly or trying to catch up each day, a comp plan is not going to do it. It's not going to be enough to keep people. It's not going to be enough to really measure the success of your business over time. So thinking about team structure, our top quartile firms, when it comes to that client-facing team, clients are not just working with one person, they're working with at least two or three, again, depending on the size of your firm, right?
Right.
But then on the operational side of the business, you do see, in fact, when we asked about some hiring trends, if you will, for 2021, they were predominantly on that operational side. Firms, I think, we saw a swing the last few years, maybe really dialing up the client-facing side. A lot of the acquisitions that are happening was to acquire that advisor talent or that advisor team. But we're now seeing where, and this, I think could be because there's greater deployment of technology. We're all working in this virtual environment more than ever, whether we want to or not. And so you've got to have people that can really support that and keep that engine running, if you will. And quite honestly, create capacity for the advisor teams to be able to go out and bring in new business. So that's definitely kicking up across our study.
Now, a word from our sponsor. Nikki Heaton-Jones is the Managing Director and the Chief Investment Officer at Betafolio, the high-tech, low-cost, discretionary model portfolio manager. Typical model portfolio service costs about 36 basis points. That's in addition to the funds, the platform, the advice fees. Tell us a bit about Betafolio's view and approach on fees.
Well, I don't think anyone that knows us already, Abraham, would be surprised to hear me say that in a nutshell, MPS fees are too high. If you include the fund charges and the platform fee that you already talked about, we get close to 1%, I think, on average for a lot of retail clients. And that's before they start paying for the financial plan, which is the part of the service that will ultimately add the most value for them in their advisor relationship and experience. My view on fees and Betafolio's view on fees is that they have a real impact on client outcomes that needs attention. And that's why we're building a scalable solution with technology that will allow us to keep costs low. And I think we also should consider the impact of these fees on advisors' businesses too. Advisors need to make a profit from their work. They need to have a viable business, and their cost bases have been rising because of regulation, and the more cost they have to pass through to their clients for overcomplicated services in turn puts pressure on the advisor's own fees and ultimately makes it not possible for them to run a good business. So fees are really crucial. And I'm really happy that we're in a position to be having a positive influence on the trends in the market.
Good stuff. Thank you, Nikki. I guess an extension of this is around compensation and talent retention is what you're seeing with things like succession planning and equity ownership within financial planning business. again, if we're drawing comparison between the faster growing firms and the slower growing firms, is there anything they're doing in terms of bringing in the next generation of talents and leaders for the business, and using or not using equity as a way to incentivize around that?
So a couple of things there, and I'll start with sharing what we saw last year for the first time in a few years around why the reason that firms reported they lost clients, which seems like a weird place to start, but bear with me for a moment. So traditionally, historically, death was the number one reason why advisors lost clients.
Right.
Last year, and we saw it again this year, it was the loss of an advisor, and certainly that competing advisor as well played a role. So we see talent moving, and boy, talk about a double whammy when you lose an advisor and they take clients with them, right? That's like the ultimate sort of pain point. So these top quartile firms are actively focused on how do we keep the talent we work so hard to get and we've developed. And when it comes to compensation, a piece of that we often see kicking in for those senior advisors is equity in the organization. So it starts often as a way to really keep your talent, reward that top talent. But as I just mentioned, now you've got equity moving deeper into the organization, which is a path, a succession path, if you will. It's a way for the founders of the firm to begin stepping away from the business. We know statistically from our study that advisors would prefer what we call an internal succession, right? They would prefer to sell the business, but we absolutely know that that's not happening to the degree that they would like it to. And that's where that M&A piece will kick in. You'll see firms come together to provide a succession solution for that founder or founders that are ready to monetize or exit the business at some point. So top quartile firms that are active on the M&A side are coming to the table and being able and presenting, if you will, they're able to present solutions to sellers that do need a succession plan of some kind. And in some cases it's, hey, we're going to sign a piece of paper that says in 5, 7, 10 years we pull the trigger. In a lot of cases, they pull the trigger right away and they're off and running. So as I mentioned, this inorganic growth muscle, if you will, is one that's pretty well built for the faster growing firms. It's not across all of them. Not all, and I often say M&A is not for the faint of heart. It's really hard to do. And certainly here in the US, valuations are crazy right now. It's, as Dave Barton said, it's frothy. So it's just a little it's crazy. That's a good word.
Is there, I don't know, is there a rule of thumb in terms of what the valuation is, multiple of revenue, percentage of AUM? I've seen all sorts. Can we glean any insights around that or not?
Well, from the study, I'll pull from last year's study because we conducted a specific M&A module, if you will, around that. And so in terms of valuation, we do see, it's based on a couple of different ways. Discounted cash flow, right? And then EBITDA is certainly a common one. Back of the napkin often crops up, which I often say, look, if everyone's on the same page and they're okay, that's all right. But you might consider a more formal valuation at some point. And certainly when you're looking at whether you're the buyer or the seller, there's two key components. One is the valuation and the other is the deal, right? The deal structure. And then, you've got multiple levers across both of those. What we're seeing right now is absolutely organizations, businesses selling for, in the double digit kind of multiples. And I'm not going to name any numbers because they're crazy. They're a little bit crazy, if you will. But certainly that deal structure is really critical, particularly if you are an organization or if you're an owner that says, look, I want to continue to grow. Actually, I'm not necessarily looking to exit the business, but I know I need a partner, right? They're at a tipping point in the business that says I either need to buy it, build it, or partner with someone to do it. And so that's driving a lot of this activity, which is actually pretty terrific because, advisors, we often say, look, you didn't necessarily get into this business to have to deal with technology or manage people or think about bricks and mortar, right? You take care of clients, you bring in new clients, that is where that's your resting place, so to speak. And so for a lot of advisors, it's about getting partnering with an organization that can help them solve for a lot of that. So, it's definitely something that continues to be a mechanism for a lot of organizations.
Talk about this, just a comment on this back of the envelope valuation method. There's a firm here in the UK that's pretty sort of relatively aggressive is the wrong word, but they do quite a bit of M&A with firms. And perhaps one of the more thoughtful approach that I have seen is where they go into a process with the firm they're buying, usually small solo advisor firms, and they work out what this advisor needs in terms of their financial plan to work, and that informs the valuation of the business. I think it's fascinating. But anyway, I want to come back to investment process, because Dimensional obviously is an investment house, so we want to see if there's any insight that we can learn there. But before I do, I'm just doing this maths in my head. I may be completely wrong, where you said firms are averaging around 20-25% in profit. They are spending about 50% on people, about 7% on tech. So I'm assuming the difference, right, then the rest in the middle is something around what? Marketing, maybe some around operations. Particularly on marketing, is there anything that the faster growing firms are doing different or better than the others?
Relative to on the investment portfolio side?
Relative to their spending, are they spending more on marketing? And if so, what is it that they're spending it on, if you know from the research?
I do, and you're going to kind of hate my answer, I think, a little bit too, because the other area that we do, so we know there's differences in comp. To round out the income statement, we'll see differences, for example, in we have custodial referral network programs here in the U.S. that feed leads. There's a cost to being at that, so we'll see some variables there. Top quartile tend to be a little more active in those kinds of programs. When it comes to business development and marketing, that is the other area of the income statement where we tend to see a very consistent number between both top quartile and bottom quartile firms. So just like with technology, we don't see a big difference in that percentage of spend. It sits right around 3.5%, and it's been there for a number of years. But again, how they're spending those dollars, we do see some differences. So on paper, it looks like they're kind of hand in hand, if you will, top quartile versus bottom quartile. But when we look at top quartile firms, they are deploying dollars into those multiple channels I talked about, the digital marketing piece, which of course can have a technology spend to it, but it's really on the marketing and business development side, it's sort of, any resources they're deploying to produce content that goes out into their digital either their digital storefront or their digital landscape. We'll see additional dollars being spent there. They're certainly doing, even in the last 18 months, we still see events happening. A lot of them were virtual or even hybrid in nature. We just had an event here where we had a whole group of clients on site, and so we're all relearning how to engage in person once again. But spending dollars in those ways, where the bottom quartile firms maybe do one or two events possibly. They spend the dollars perhaps maybe on some branding, but they're not necessarily dialing in around search engine optimization, lead gen, some of these different areas that we see a little bit more innovation happening with the top quartile firms.
Good stuff. Thank you very much for that, Catherine. So then, investment, right? This is Dimensional bread and butter, and we know all the firms you're serving are Dimensional firms. They use Dimensional in some shape or form. But again, anything that we can glean from how firms are doing things around that side of things.
A little bit. Fortunately for everyone, I sit over and I get to talk about everything else with clients.
Right.
Don't necessarily have to delve in on the event. We have amazing people here that do that much more purposely. But certainly within the study, we do ask a few questions, a couple questions anyway, each year around the investment piece. And some years we dial that up, and other years not so much. What we do tend to see with the top quartile firms is, a continued approach to broad diversification. We know from our global investor study that end clients, while you might start or lead with financial planning, they do care about the investments, right? They want to know that you have the acumen to deliver on the investment side. They want to see, a broad investment platform, if you will. And certainly for our larger firms or firms that are working with ultra high net worth or even family office sort of scenarios, we often see market neutral and alternatives and tangibles, and some of those things really kick in for those types of firms, and that definitely shows up in our study. What I would offer is that when we look at the underlying team structure and the vehicles for delivering that out to clients, we tend to see a much more simplistic approach with top quartile firms, meaning they don't have dozens and dozens of models. They've got a concentration within the organization about trading and portfolio management. They've really structured the organization to be as efficient as possible. And it's not because, as I just said, it's not because their clients don't care about that and they want to be over focusing on financial planning, right? That is absolutely not the case. But from a business efficiency and productivity standpoint, they know they need to have a broad investment platform. They know that some of that may be, they've got outside managers they may or may not want to pull from, but how do they make that as efficient as possible? And the last comment I'll make, we do ask about what percentage of clients receive certain services in the business, and certainly on the investment side, for the most part, it's about 100%, of course. Right. There are some that lean in more with the financial planning piece, but the top quartile firms are very dialed up on both those areas, and they're also then delving into some of those alternatives, some of those other areas of an investment offering that just create ample, additional opportunity to capture greater share of wallet with clients. We know that for a fact with top quartile firms. They have a greater share of wallet because they can meet the investment needs. They're not necessarily the client doesn't have to leave, $1 million sitting elsewhere because the advisor can't introduce or manage a portion of that. So we do see that greater share of wallet kick in as well too.
Good. And this is a great segue into the global investor study, right? But before we go into that, on the client side, so again, is there a difference in terms of the size of assets, the level of fees that the faster growing firms are, charging than the others?
Yeah, it's pretty consistent in terms of the level of fees that are being charged. We might see a slightly higher fee with the smaller firms.
Right.
Or slower growing is probably the right way to phrase that. But for the most part, it's actually quite, in terms of the actual sort of percentage, if you will, of what revenue or how, the fee structure, if you will, that advisors are deploying. With that said, with the actual fee percentage that they're deploying, fee structure, we do start seeing some differences. So top quartile firms are more likely to have hybrid pricing. So maybe they're charging based as a percentage of assets under management, but they've got perhaps a flat fee, a quarterly fee of some kind of retainer fee that they might be layering on to focus around financial planning, for example. We do see some organizations, this is particularly a little bit high in Australia, the subscription pricing. So think about Netflix, right? We're all we're all living in a world of subscription pricing, and so that's actually starting to kick up a little bit. And we saw that globally in our study go from about 22-23% last year to about 26%. So it continues to kind of creep up a little bit. The reason for firms introducing, if you will, this hybrid pricing is to more few reasons. One, to more closely align the services that they're providing with the with the fee that they need to charge. Again, that you heard me mention that profitability piece kicking in for a lot of organizations. They may be going after a younger, newer, different segment of clients, and it makes sense to have different kinds of pricing to meet those clients where they're at. We often think naturally of the accumulators, those Henrys, right? High earners, not rich yet folks. And, having subscription pricing or retainer pricing, those kinds of things, to get your arms around them and when they're in accumulation mode. And then when they're the kind of, the sort of that target client over time, you might shift that a little bit. So those are some of the reasons that we see that kicking in for organizations.
Yeah, it's interesting that fee model is creeping up in Australia in particular. I wondered if that's got anything to do with their regulation, this thing where they're separating advice out from investment management a little bit. But anyway, moving to the Global Investor Study then, again, just give us the highlights. What can we learn from that study?
So maybe not surprisingly, I don't think it's surprising. When we look at the Net Promoter Score in our study, we have amazing advisors. So it's a really, really high number. And if you're not familiar with that structure, we won't necessarily get into it today, but it's a form of essentially measuring client satisfaction. And in particular, it is based on a single question of, would you refer? Period. Right. Like, would you refer your advisor? And how they answer that question denotes where they land on that scoring side. So we absolutely see in general a high score there. From there, we measure, and we can cut this across lots of different demographics and insights we gain from the clients themselves. What we do overall tend to see is that when it comes to measuring the attributes of their advisor relationship and of their advisor, the things that they value the most, you don't see, for the promoters, you don't see words like fees and pricing. You don't see words like performance. You see words like peace of mind, sense of security, trust. And, I know come to work each day with clients hoping that is how they feel. But don't discount if they, that don't take it for granted that they're always going to feel that way. And that absolutely shows up with those top firms. And as a result, when we look at the characteristic, and again, we're splitting hairs here because that NPS, the Net Promoter Score, is high in general. But when we look at the super high, those top firms, and we look at how they're running their business, again, this is that relationship between the two studies. Those firms, they've got super high NPS. Their clients are really engaged. They're evangelical about what they do. We see a higher propensity, high appetite in general to refer, but we tend to see a little bit more of those clients actually referring. When I'm presenting into a room of advisors and they look at these numbers around their clients saying, I absolutely would refer my advisor, and they're looking around the room thinking, well, it says here that 37% of my clients would refer in a heartbeat. I didn't get a third of my clients referring last year, right? So what's happening there? And that's often a different discussion. But we definitely see that kick up as well. And those top firms are typically providing some additional services. They really have a nice service offering to their clients. Again, this doesn't mean you need to immediately start offering things like bill pay or account aggregation per se, but they've figuring out ways to really meet clients where they're at and think about the fact that if they're not getting something from me, they're going to go down the street potentially to get it. Right. The last comment we do see with those high promoters in our study, this is going to sound a little bit funny to say this out loud because of the sheer breadth and depth of everything that advisors do for clients, but we see for those top firms in the client feedback that advisor responsiveness is something that they really put a lot of treasure on. And again, I'm sort of laughing because it's like, well, first of all, it's like, well, of course, but they really do put a premium on that and they appreciate it. We were talking last night at dinner. I had, a couple of advisors sitting there. I'm going to be, they're in their late 50s, early 60s, and they're frustrated because they've got young advisor professionals that are like, no, I turn my phone off on Friday and I'll turn it back on Monday morning, right? And that's okay. I mean, we should probably take a few notes about work-life balance from them, but it's like, wait a second, but if clients are really valuing, and we can have you and I can have a whole different discussion about how to navigate all of that, but it's kind of funny. Like, it's great. And we've had advisors that see that result, and really it's a visceral reaction. Like, they really do think about, okay, what are we doing, particularly over these last 18 months where you couldn't go and sit across the table from that client as a form of responsiveness, right? Like, you really had to think about, how do I get back to these clients and make sure that they're not feeling nervous, they've got that peace of mind, sense of security very much kicked in. So there you go.
The thing that sort of interests me or amazes me about, when I'm looking at this investor study, is that you asked a question about the value of advice, how people value advice, how they measure the value of that they receive from their advisor. And most people, 40% says something like the sense of security, peace of mind, which we know. A further 20% says knowledge about my financial situation. I think there's another 20% that says progress towards my goal, right? All that is great. And then you say, well, which are the top attributes that you consider most important in the relationship? And, at the top was experience with clients like me. Second was investment returns. So is this a conflict between what clients say they value and the attributes they look for in their financial advisor? Again, I'm asking this in the context of everything we talk about, the rise of financial planning, let's focus clients away from investment returns and to their goals. But every time you ask them these questions, investment returns pretty strong.
It is, and I love that you asked this question, and specifically, is there a conflict there? Because yeah, you could look at that on the surface, and I certainly have a number of advisors that have said, well, wait a second, like, that's not even where we start from, right? We are focused on financial planning. Like, why would that be such a high area or area of importance, if you will? And it goes back to what I said earlier. They do want to know that you've got the acumen, that you have the resources, you've got the ability. The investment accounts, of course, and your investment platform is the vehicle to achieving your financial goals. And so a lot of advisors will say, well, it's all sort of gets meshed together. But that's why, and they do want to see that. And for what it's worth, we ran this study a couple of years ago across 3 different fielding periods. So both of these studies have single fielding periods where we capture the data, if you will. Usually for Global Advisor, it's in the spring, and then we're actually just right now about a week and a half out from closing the Global Investor study for this year. So they're two different fielding periods. But when we ran it a couple of years ago across 3 fielding periods, we did that to see if there was any seasonality, there was any market play, right? If you'd surveyed your clients in January versus in November, no, they, like the markets could be up, the markets could be down, right? There, we didn't see, they still want to see that, even, and maybe when the markets is up, it's a little bit of fear of missing out on stuff. Like, there can be different motivators, but clients still put a great deal of emphasis on that, but how they feel about the relationship, what ultimately galvanizes them and adheres you to them between an advisor and a client, is how they feel as a result of that, how they feel about the services you provide. They walk out. We know, for example, widows, they have according to our study, there's a strong fear there of, a life event of some kind, which obviously it was a life event that caused them to become a widow. So that very much stays with them. What they most want to feel after they engage with their advisor is educated. They want to understand what's going on. And in many cases, it's starting from scratch, depending on how engaged they were prior to becoming a widow, but certainly even ongoing. And then they're also more likely to open up emails from you a little faster than women who are married or, in a relationship. And it's not that married women don't care or want to know. But when you know that about the clients you're working with, and we have advisors here that are laser focused in around women in wealth, widows, what's happening, how they approach money. When you know just those kinds of things, right? How they want to be communicated with. Is it an email versus a hard copy? Do they want an email versus a newsletter? Those kinds of things you can get into with our study, and it can absolutely inform the client experience, reinforce the great things you're doing, but also inform when you want to, those are the clients you want to replicate. And it's an anonymous survey, so you don't specifically know. But this is why these demographics are so important. But if that's an area of pursuit for you, maybe that's a niche client, for example, you want to go after. Now you've got some great insights about what they value, and you can put that out there in your prospecting process. The next set of clients you bring in the door, and that's really where we see kind of the rubber hit the road with that study.
Wow, Catherine, there is just incredible amount of insight in all of that. So thank you very much for the work that you do, for the insight that you bring to the table. To wrap this up, I always like to ask my guests how they approach their retirement. Now, don't take that as an insult. You look to me like you're in your 30s, which you are, I'm sure. But just looking out, how does Catherine Williams, head of practice management at Dimensional, approach? How does she approach our own retirement planning?
Well, first of all, you can edit out that part about looking like I'm in my 30s. It's very nice of you to say that. That's not the case. I have 2 grown children, and I've been doing this for a little bit of time. So, my approach to retirement it's been a process. I often people say, well, you've been in the financial industry for years, so surely you must know exactly what to do and how to go about, thinking about your retirement. And the reality is, I needed an advisor, just like everyone else. And so that's critical, right? To get that, to find that advice, find that person, those people who can understand your situation, meet you where you're at. And that's absolutely been the case with me in particular, because, I've had life events, whether it's moving, raising kids, divorce, all those kinds of things, not to get too personal, but they can impact you financially. They can also impact your confidence level about being ready for retirement. We talk about this a lot, particularly with women, and how we view finances and what happened as children even that inform that. So for me, I would say I'm behind the curve a little bit. Like I wish I was further along. And so having an advisor that not only says, well, you're not as bad as you feel like you are, but here's what we need to do to kind of get you moving forward. And certainly, taking full advantage of an incredible 401k program here, getting access to Dimensional funds, I would say is a really, really critical piece of that. And then just being mindful of, do I want something now that will create some short-term satisfaction versus if I put it away, it'll be there when I'm ready to retire and I have a longer-term outlook. And, I live life to the fullest. I love to travel. I love to do all kinds of things. And so continuing to strike that balance, that's a conscious decision that I have to make all the time, because I'd much rather go do something really fun right now. So I have to, having that discipline of asking myself what would be instant gratification versus if I put it away, it'll serve me down the road. And that's something that I would definitely am still mastering. Maybe there's some people listening that can put their hand in the air and agree with that. But
no, thank you. He actually makes the rest of us feel much, much better. If your humble approach to the whole thing, it makes us feel better, because we realize that actually, we're not the only one. I'm not the only one struggling with figuring out how much you save for retirement versus spending the now. So thank you for that. Now, for advisors who are listening to us, your podcast is a great one to find. It's on iTunes, Apple Podcast, Managing Your Practice by Dimensional. Where else can we find you? Catch up with your work?
Well, thank you very much, and I will say I will offer as an Android user, you can also find us on Spotify and all the usual platforms. So I get a lot of flack for not for not being an Apple user, but certainly. If you're an advisor that's currently working with Dimensional, we have just I would say an incredible catalog of resources. So much, virtually all of it is initially informed by the data we gather in these two studies that I mentioned, but then it shows up, if you will, for advisors in terms of tools, resources, additional videos, all kinds of things that, if there's a particular topic or area of the business that you are focusing on, we know as we headed, we're in the fourth quarter of 2021. I'm not sure exactly how that happened, but as you start thinking about your planning for 2022, some great resources that can help inform different areas of your business if you're working with Dimensional. Beyond that, certainly, I'm out and about in the investment community, different conferences, things like that. So you can follow me on LinkedIn. That can be a good place to kind of keep up on what I'm doing. But it's great. It's great to be here, and absolutely excited to share some of our insights with you today.
Thank you, Catherine. And if you're ever in London, if you ever come this way, let me know, and we can get some advisors together and give you a bit of, I'm sure you've been in London before, but give you perhaps a flavor of London that you haven't had before. Catherine, thank you very much for your time and for your wisdom, and keep up the good work.
Thank you. You as well. Great to speak with you.
I'll be remiss if I don't thank my incredible team who worked very hard to put this program together, led by my producer, Hannah Dickinson. Thank you very much, guys. I'd like to thank our sponsors, Timeline App, the retirement planning software, and Batefolio, the high-tech, low-cost flat-fee model portfolio manager. And to you, our listeners, thank you for your time. I hope you've had as much fun listening to the program as we have making it. You can find more about the show at retirementals.co.uk, and you can follow me on Twitter. My handle is Abraham on Money. Until next time, thank you and goodbye.